Let's start out with inflation. During the last webinar, you reported that the Consumer Price Index was 5% or greater for May and June. Since then, we've had 3 more months of year-over-year inflation of 5% or more. You also mentioned that the Federal Reserve was holding steady on rates because it felt that inflation was transitory. So here's what Janet Yellen has said about inflation over the last several months. In February, there's nothing to worry about. In March, inflation was small and manageable. In May, again, she said it was temporary. In June, it could reach 3%, but again, it's transitory. And then now in October, we're told that it's going to be higher for the next several months. So why do you think inflation has been so persistent, and how long will this current bout of inflation last?
So Joe, before I start, if you worked for the Atlanta Fed, you would have just been fined $2 because you used the T word. Last week, the Atlanta Fed president, who so dislikes that word, stated that he will now fine anyone $1 that says it. But before I address the issue of inflation, Joe, I'd like to start out by saying that the pandemic has completely changed the economic playbook. Economists and investors, including us at Wespath, have been trying to understand how the economy and markets will respond and evolve based on the old playbook. The ongoing rapid transformation resulting from lockdowns is rewriting the economic playbook. Where we live, who we see, where we go, how we work, what we buy, all of this has changed, and I mean changed in a big way. Further, I feel confident in saying these things have changed forever. And Joe, I believe there are many more chapters to write, and it's anyone's guess how this story is going to end. We've seen record fiscal and monetary stimulus from the United States and most of the rest of the developed world. We've seen many countries that continue to impose lockdowns and restrictions on the movements of goods and people. For those not aware, type Australia and lockdowns in Google. Australia has the unrealistic goal of zero COVID, and their citizens are paying the price. As mentioned, we have seen massive changes in spending patterns. With the benefit of hindsight, it seems fairly obvious that inflation is a consequence resulting from all of this. So now let's directly address your question, Joe. Let's first look at the overall inflation picture. Regular viewers of our webinar have seen this slide before. The left shows the Federal Reserve's preferred gauge of inflation, the Personal Consumption Expenditures Price Index. The chart on the right is the inflation measure that most of the rest of us follow, which is the Consumer Price Index. It's clear that the Fed's preferred measure is running quite a bit above its 2% average inflation target. And as you said, Joe, the annual increase in CPI has now been over 5% for the last 5 months. I've also shown this next chart before. It's a reminder that 60% of CPI is comprised of food and shelter, things that we can't live without. Throw in medical care, which we certainly can't do without when it's needed, and we've accounted for nearly 3/4 of CPI. Now this next chart is a portion of what I showed during our last webinar. The point that I made when I showed this was that inflation for food, shelter, and medical care seemed reasonably under control, and that the main culprits for the 5% increase in inflation we experienced in May and June were huge price increases in various components in the transportation sector. So Joe, you may ask, what's changed over the last 3 months?
And I'll ask, what's changed, Dave?
So on this next slide, the chart on the left is the exact same May and June data that I showed on the previous slide. The right chart shows the inflation data for the same categories for the 3 most recent months. As you can see, inflation has definitely picked up for 2 of the categories, food and shelter, things that we care most about. Notable is inflation for meat, which has risen 20% in the last year for many meat products. Now you asked, Joe, how long this current bout of inflation is going to last. To answer your question, let's look at trends for what investors and consumers are predicting for future inflation. On this slide, the chart on the left looks at how the inflation views of lenders have changed over the last 3 months. More than twice as many lenders now think inflation will be greater than 4% for the next year. The right looks at consumer inflation expectations, which are also rising. Now, I should note that consumers are usually always overestimating inflation. But regardless, depending on your definition of the T word, it looks like higher inflation is going to be with us a bit longer than we and the Fed may have hoped. I want to show one more slide while we're discussing inflation, where I selected two categories that have seen meaningful, if not dramatic, increases in price. China ships a lot of stuff to the US, and for various reasons, shipping costs have skyrocketed. As you can see in the chart on the left, the cost to ship one container from China to the US is up about 9 times of what it cost just 5 years ago. A significant reason for the rise is pandemic related. A week ago Saturday, the Wall Street Journal had a lengthy front page article about the global supply chain problem. Now, when I say the words supply chain, I'm referring to all the processes that occur to produce and distribute stuff. For example, raw materials are needed to make components, which are used to make products, which must be packaged, shipped, and either stocked on shelves in stores or inventoried in an Amazon distribution center. There are many steps required to put a product in consumers' hands, with a lot of people and transportation required to get them there. If there's a backup or a figurative traffic jam at any point along the way, you've got a supply chain problem. Now, the pandemic started the supply chain nightmare we are currently experiencing. There has been a lot in the press about this over the last couple of weeks. The simple explanation for what is causing the problem is a massive change in consumer spending habits. Because of the pandemic, we are buying a lot more stuff rather than spending our money traveling, going to restaurants, concerts, or ball games. A lot of us have moved and we want to make changes to the new home we purchased. We are also working more at home and want better equipment in our home offices. We are getting to those projects that we've put off for years. Our spending patterns have changed in a big way. Now, the Wall Street Journal reported that continuing lockdowns, labor shortages, along with increasing bottlenecks, are creating backlogs and bidding wars in China for shipping containers overseas. The article indicated that ships going into China must sit offshore and quarantine for 7 days before they are allowed to dock. That's what caused the spike you see on the chart.
So now, Dave, I know we've talked internally about the ports of Los Angeles and having, at one point, I believe, 73 ships was a high that are off the port of Los Angeles. But it's more than that, because it's the trucking on the ground, it's rail, where we don't have enough people to move the goods once the ships are even in. We know Joe Biden has come out with a plan last week that's going to look at the ports of Long Beach and Los Angeles and move them 24/7, but there's varying estimates on how much that's actually going to help. It strikes me that it might just be time that we need, but what are your thoughts on that?
Yeah, that's right, Joe. And it's great to see that the administration is working to try and resolve the problem. I've got some charts here to show you on that. The chart on the right shows the path of commodity prices as measured by the Bloomberg Commodity Index. Commodity prices are close to double what they were immediately after the onset of the pandemic, and up 34% this year through last Friday. This must inevitably translate into higher prices for most everything that we buy. I think most of our viewers have seen firsthand the extent of higher prices when they fill up their gas tank, unless, of course, they own an electric vehicle. As I said at the beginning of my comments, we are writing a new playbook. I still strongly believe that increased globalization and technology and the advancements resulting from technology are long-term headwinds for higher inflation. But we may have to resolve ourselves to the fact that elevated inflation could be with us a while longer. So I think I'll stop here, Joe, though this is certainly a subject that we could spend the whole hour discussing.
All right, Dave, so I want to come back to inflation in a little bit, but maybe we can shift to employment in the U.S. So the financial press showed that the Department of Labor's September unemployment number came in at a disappointing figure of 194,000 jobs. This is compared to the 500,000 new jobs that we'd been expecting. but the unemployment rate fell from 5.2 to 4.8%. And it seems that that's nearly half a percentage point decrease. The unemployment rate would be considered very good news. So can you tell the viewers why this report was seen as disappointing?
Yeah, that's right, Joe. Let's take a look on this slide at the three key elements of the employment report that was issued by the Labor Department back on October 8th. The chart on the left shows the path of the unemployment rate. Now, it's important to keep in mind how the Labor Department defines unemployment. To be considered unemployed, an American citizen or legal resident must be actively seeking employment. If one is not actively seeking work, that individual is not considered to be unemployed. So hence, the 4.8% rate of unemployment means that 4.8% of those working and actively seeking work have been unable to secure a job. Up until recently, an unemployment rate below 5% was generally considered to be full employment. There will always be frictional unemployment among those that lost their job for whatever reason, or quit to find another job, or just recently decided to move on to something else. However, that calculus has recently changed as the U.S. experienced generational low levels of unemployment immediately prior to the pandemic. This was true across all demographic groups and education levels. As you can see, with the onset of the pandemic, unemployment ballooned to nearly 15% as the country imposed lockdowns and business closures, notably in the hospitality industry, occurred. But as America began to adapt, employment began to recover. This was largely attributable to the change in buying habits, as hundreds of thousands, if not more than 1 million people, were hired by the likes of Amazon, Walmart, and others involved in delivering goods and services directly to your door. We did see some months of lost jobs as various parts of the country saw surges in COVID rates. But generally, the country added hundreds of thousands of jobs each month. But as you mentioned, Joe, economists in the financial media branded the September report as a disappointment. And if you look at the chart in the middle, you can see that the number of jobs added in September was the lowest for any month in 2021. Now, some have considered the light report as a statistical anomaly. They note that the private sector actually added about 320,000 jobs, and the culprit was actually 125,000 jobs lost to the public sector, and noted that this might be due to the way the government adjusts the data for various seasonal factors. Nevertheless, the big concern expressed by many was the drop in the labor participation rate, which you can see in the chart on the right. Remember, one is only considered unemployed if one is working or actively seeking work. If you aren't looking for a job or actively seeking work, then you are not participating as a member of the labor force. Hence, as you can see in the chart, the percentage of the U.S. population working or seeking work remains considerably below pre-pandemic levels. The Wall Street Journal reported that a survey conducted by website recruiter Indeed revealed that the number one reason people gave for avoiding work is their fear of catching COVID. Other factors including parents staying at home to care for their kids, and while schools remain closed, and then there's also a shortage of childcare workers. But I think this next slide gets to the heart of your question, Joe, as to why many consider the employment report as a disappointment. The need for workers has never been greater. There are plentiful jobs that are simply going unfilled. The chart on the left shows that the number of job openings is currently 11 million. And as you can see on the chart on the right, 9 million of those workers can be found among those that, for whatever reason, have removed themselves from the workforce. Now, of course, part of the reason many of these jobs remain unfilled can be attributable to either a skills mismatch or that the compensation is viewed by qualified applicants as just insufficient. Now, I'm going to get a bit wonky here on you, Joe. I ran some numbers based on historical data from the Bureau of Labor Statistics. The lowest unemployment rate ever recorded was 2.5% way back in 1953. If enough people currently out of work found a job to get the unemployment rate down to the all-time low, we would still need about another 7.5 million workers to fill the open jobs. That means we would need to motivate an additional 7.5 million people to join the labor force, meaning that the participation rate would have to go up to 64.4% to get us to a point where all open jobs have been filled. It's been over 10 years since the participation rate was that high. So I think, Joe, that it's fair to say that we've got a long way to go and we'll need some creative solutions to alleviate the shortage of workers.
So Dave, let's shift to the economic growth in the U.S. So the economy grew about 6.5% for the first and second quarters of the year, yet the Atlanta Federal Reserve, who you often reference, is forecasting only 1.2% for the third quarter. So this is considerably below what economists had been forecasting at the beginning of the third quarter. So why have growth expectations fallen so much?
Well, it's the pandemic, Joe. We've talked about supply shortages resulting from the transformational rewriting of the economic playbook, the where we work, where we live, what we must buy, etc. We've also talked about a massive labor shortage. The latest wave of the virus we've seen during the summer has exacerbated these structural challenges. So let's take a look at some of the data. The chart on the left shows the Atlanta Federal Reserve GDP Now estimate for the third quarter at 1.2% that you mentioned. We see quite a significant drop from its 6% estimate that they made at the beginning of the quarter. What's notable here is that the Atlanta Fed estimate has significantly diverged from the average 6.3 estimate of blue chip forecasters from just 3 weeks ago and 3.8% more recently. Now, for those of you keeping score, the Atlanta Fed's final second quarter estimate was 7.9%, which was closer to the final 6.7% GDP reading compared to the blue chip forecast of 9.4%. Now, the right chart looks at actual U.S. economic output compared to trendline growth. I should note that I do not consider the 4.3% growth rate experienced from 2016 to 2019 as being sustainable. Rather, I assume that the economy would have grown at 2% had there been no pandemic. While the good news is that economic output surpassed trendline growth in the second quarter and is expected to remain ahead of trendline growth for the third quarter, the bad news is that we still lost $4 trillion of economic output due to the pandemic. Now, there's more to add here, but I know that you're ready to ask me a question about another question about this topic, so I'll pause here.
So Dave, with inflation high and economic growth slowing, do you think that the U.S. is at risk of stagflation, which is defined as inflation in a recessionary environment?
No, not really, Joe. First, it's probably a good idea for me to define exactly what the term stagflation means. Now, according to Lexico, powered by the Oxford Dictionary, stagflation is persistent high inflation combined with high unemployment and stagnant demand in a country's economy. We have a ways to go before our economy can be defined as in a period of stagflation. Now let's look at each one of the elements in this graphic, starting from right going to left. First, we've only had 5 months of 5% inflation, so check back with me in about another 6 months and we can start to talk about whether or not we've had a prolonged period. Now, we know that demand is not down. In fact, demand is through the roof. Consumers have pent up savings and are anxious to spend. The problem is that they can't buy the stuff that they want to buy because of persistent supply shortages. We are just not going to see a demand shock anytime soon. Now, you could make a case that unemployment is up. Clearly, as I showed a few minutes ago, the unemployment rate is definitely down, but so is the labor participation rate. So if you define unemployment as eligible workers that refuse to or don't have the requisite skills to get a job, then I suppose you could make the case that unemployment is rising. So that brings us to GDP. As I just mentioned, we still have to make up $4 trillion of economic output lost to COVID. But despite the current rate of inflation, and assuming that we don't see a COVID variant resistant to vaccines, heaven forbid, I have to believe that the world will start to address these supply shortages and that economic output will remain robust for the next couple of years. So bottom line, it's just way too early to start worrying about stagflation.
Let's have one more question about inflation, Dave. So even though inflation is the highest rate of inflation amongst developed economies, the dollar has steadily risen, having bottomed out earlier this year in June. So this seems counterintuitive. So why do you think that the dollar is strengthened given the backdrop of U.S. inflation?
Yeah, Joe, you're right. The recent dollar strength is a mystery, and I'm hard-pressed to provide you with an explanation for that. The chart on the left on this next slide confirms what you stated in your question. While inflation has definitely increased in other parts of the developed world, the U.S. does have the highest rate of inflation. Yet, as you can see on the chart on the right, the dollar has actually moved higher from levels earlier this year and after the U.S. reported the second of 5% inflation. What's even more confounding is the prospect of a U.S. debt default absent a raise in the debt ceiling beyond December and the potential inflationary effect of the president's $3.5 trillion Build Back Better spending package. I suppose the best explanation is the differential between U.S. interest rates compared to other countries' rates. Notable, the U.S. 10-year note currently yields about 1.6%, whereas German 10-year bunds remain in negative territory, and Japan's 10-year rate is just barely above zero.
So Dave, in the few minutes we have left, I wanted to shift to emerging markets and specifically China. So there's been a lot written in the financial press about China in the past several months. So these stories, they've centered around the regulatory crackdown that the Chinese governments have imposed, and also the financial difficulties of Chinese property developer Evergrande. So Chinese stocks are down in the mid-teens so far in 2021. So to what extent do these developments threaten Wespath's worldview, specifically optimism for emerging markets, and then specifically to China?
Yeah, you're right, Joe. China has certainly been a lot in the news lately, and it's unsettled the markets. And as you mentioned, Chinese stocks are down in the mid-teens, which contrasts to the double-digit positive gains in the U.S. and many other countries around the world. I think the number one issue remains the coronavirus. As you know, the Chinese have been very aggressive in trying to control the spread of COVID. Lockdowns are imposed quick and often. Compound that with supply shortages, notably semiconductors. Hence, it's understandable that manufacturing activity in China is not as strong as might be anticipated, given the global demand for goods. Now, showing on this screen is the manufacturing heat map for emerging countries that I frequently show. The state of China manufacturing currently is neutral. Now, what is also weighing down on Chinese stocks is increased government regulation and restrictions on certain industries. Notable was its prohibition on profits for the after-school private education sector. Chinese parents are very motivated to ensure their kids are given every opportunity to compete for limited but highly coveted places in the best schools. Hence, they are willing to pay whatever it takes for after-school education resources to ensure that their child can compete. However, China sees a shrinking workforce resulting from its decades-long one-child policy and is now encouraging parents to have multiple children. Given the amount spent educating one child, parents were unwilling to have additional children. Hence, the Chinese government is now prohibiting for-profit supplemental education programs. China has also adopted regulations limiting online video game playing for young people to 3 hours a week. There are a number of other rules on the technology sector that's being imposed by the Chinese government. And then there's Evergrande. Again, we could have filled up our entire time talking just about Evergrande. In a nutshell, this is a company that, as they say, got ahead of its skis. The company is the second largest real estate developer in China, but it also operates or has significant ownership interests in a lot of other businesses, such as theme parks, electric vehicles, insurance, retirement communities, mineral water, and it also owns a soccer club. It borrowed boatloads of money to the tune of $300 billion, and it's having difficult time paying all this money back. It has a lot of apartments vacant or still under construction. It could go bankrupt and dump a lot of housing inventory on the market, which would have the effect of depressing housing prices. Now, the problem here, Joe, is that housing represents by far the greatest proportion of the average Chinese citizen's net worth. And if they were to see the value of their homes drop, then you are going to have a lot of unhappy Chinese. Again, it's anyone's guess as to how this will ultimately resolve. I am a bit worried about this, Joe, because the experts are pretty much dismissing the possibility that this is China's version of the 2008 US housing bust. I confess that I just got around this weekend to watching The Big Short for the first time. Now, for those of you that haven't seen the movie, it is the story about a group of investors that discovered that the housing market was a house of cards, or Jenga blocks for those of you that did see the movie, and the Jenga box about to collapse. Now, prior to the US housing market crash, all the experts thought that the housing market was strong and a crash was nearly impossible. And we all know how that story played out. All that said, I still believe that the long-term story for China is bullish. But this certainly is a story that bears watching.
Great, Dave. Thanks for that update. Thanks for being with us today.